Hello friends, welcome to Adda 24/7. We are in the Shikhar series for BFM. In fact, in Shikhar series, if you see, we are covering all the subjects ABM, BFM, ABFM, BRBL. Today we will be covering BFM and that also market risk. It is an important topic in your module B in BFM. Market risk is the most important risk in banking industry now. Why? Because credit risk, operations risk and market risk. These are the three risks. Credit and ops you can control because those are in your hands. But market risk is not in your hands. Like for example, Russia invading Ukraine, immediately oil prices up, dollar changes, your bank position changes. So that's why it is important. This was just an example. So that's why follow the video till the end. Share it with your friends. Like the video. Watch the complete series, Shikhar series. Okay. Let's start. Have you liked the channel? Subscribe the channel. Not yet. Do it first. Let's start. Today's topic is market risk. Okay. So first I'll be covering the theory. And after the theory, then some objective questions, and then I'll be going for an important numerical. Watch till the end. Numerical will come at the end, surprise element. Okay? Let's start. Sure. What is the market risk? The risk of loss due to fluctuations in the market prices, such as interest rates, foreign exchange rates, stock prices, means what? Read this first. Risk of loss due to fluctuations. See this, due to fluctuations. Okay? Due to fluctuations in the fluctuations. So let me hold on. Due to fluctuations. Okay? Fluctuations. Why do these fluctuations happen? Why do these fluctuations happen in the market? These fluctuations happen because the world condition changes. World situation changes. Means for example, right now you see US, the new president has come in. So there are talks of de-dollarization going on. There are talks of wars going on. Somebody might invade somebody, like Israel is going on with the attacking the various countries. Attacking means, after all, that's a separate aspect. Somebody can have a debate on it, but something is going on in that region. Similarly, you can see Russia and Ukraine war. Similarly, now if some China and Taiwan breaks up, then what? Means many things can happen, and all these things will lead to the changes in the world order and changes in the oil prices, dollar prices. Immediately your repo rate changes because the inflation changes. Okay, so fluctuations happen due to this. Market prices such as interest rates. Interest rates means, interest rates mainly we consider, whenever we say interest rate, we actually consider repo rate, mainly in banking. I am just talking from the aspect of banking. We consider repo rates, then we consider this CRR. These are the two main elements which we always focus on in banking. So repo rates and exchange rates. What are exchange rates? See this, exchange rate over here means mainly dollar forex, related to dollar. Now it can be dollars here. Exchange rate for each currency is different. Each currency is changing differently. If you check the UK pound, it has fallen a lot since so many, almost last 2-3 years in comparison to the dollar. If you check the Japanese yen, that has also fallen. So major currency in the world right now, which is considered as a universal currency as of now, that is basically the dollar. If dollar changes, everything changes. Okay. So exchange rates. Now exchange rate, somebody can argue, why only dollar? Why only currency? I can consider it as a oil also, petrol. I can consider it as gold also. So anything, here, depending on in which market you are in, it depends on that. Okay. So exchange rate and stock prices. Stock prices means obviously once the exchange rate changes and the interest rate changes, the stock prices will definitely change. They will be affected. Okay. Market risk can be managed by diversifying the investment portfolio. Diversifying means what? What do you mean by market risk can be controlled or managed? How do you manage the market risk? What is basically here? If you don't put all the onions in the same basket, this eggs words we have to remove it now. Onions we have to be vegan now, right? So if you don't put all the onions in the same basket, then you are saved. If you put all the onions in the same basket, if one onion is gone, every onion is gone. Right? So that's why market risk can be managed by diversifying the investment portfolio. You need to diversify this in either stocks or bonds or T-bills, okay? Or various other instruments. You can diversify it in gold also. Depending on your investment, now we have e-gold also. So depending on the investment strategies and the investment manager, you will diversify it. Okay. Liquidity risk is the offshoot of market risk. Offshoot means what? What is liquidity risk? Liquidity means how much cash am I having? In our daily life also we have this concept. Means what? Do I have the money to pay my upcoming EMI? Let's say today is what? 28th? Yeah. Let's say there is the EMI on 1st of February. Do I have the money, sufficient money to pay it? If not, then how will I arrange for it? Liquidity means having ample money to run the current working position. It's also as simple as working capital. Isn't it? So liquidity risk, the risk of not having enough cash or other liquid assets to meet the short-term obligations. Short-term, look at this, short-term obligations. Okay, short-term means next, coming up. EMI, I just gave you one example of EMI for your, at a personal level. You can have this in many things. Some company might be having the liquidity position or short cash crunch in terms of salaries, giving salaries. Anything. Some government can be having, or some company can be having the short position or a crunch for paying up the bonds which are maturing now. Anything. See here, cash crunch can happen anytime, and commonly, kindly understand, this liquidity risk is a common feature to all the banks. You name it, big bank, small bank, good bank, standard bank, NPA bank, every bank. All of them have this liquidity risk. All of them. They always face this liquidity. Every company faces the liquidity risk. Why? The reason is there is a rule. Okay? There is a rule which says that expenses expand and eat up the income available. Simple rule. Expenses expand and eat up the income available. So whatever your income be, you let yourself be the biggest bank in the world. JP Morgan, let it be you, let it be SBI. Every bank will have a cash crunch because their expansions or their visions are bigger than the money that they have. Same is with human being also, isn't it? Same thing happens to you and me also. So, the risk of not having enough cash or other liquid assets to meet the short-term obligations, liquidity risk can be managed by improving the cash flow management and monitoring market conditions. Cash flow management means I need to see to it that I don't only get long-term funds, I also get the short-term funds. That's why RBI, look at this RBI. RBI has put in a system called a bucket system to the bankings. Okay, bucket. What is this bucket? Bucket system. What is this bucket system? It starts from overnight. It says that you have to match your assets and liabilities from overnight to importantly 28 days. First 28 days are very important. After 28 days, it goes for 1 year. After 1 year, it goes for 5 years. So up to 5 years, RBI is very strict about it. You can go further also. You can match your assets and liabilities for 10 years, 20 years also. But RBI is very particular about 5 years and more particular about 28 days. So that is bucket system. Once you match this, see this, can be managed by improving the cash flow management. This cash flow management can be managed using this bucket system. And monitoring the market conditions. What is going on in the market? So accordingly, your treasury, your fund management team should take the positions. Very simple. If the world is moving towards downside or the world markets are moving towards downside, you have to take accordingly the short position so that you earn in that. If the world or the world markets are moving towards long, upside, then you have to take the long position depending on what the world markets are or the market in which you operate are. Okay? The market risk, now these are the questions for you. See, I told you theory, objective questions and numericals. So theory, I just explain you what is the meaning of this market risk and liquidity risk. Now we'll go on for some questions. The market risk arises on account of transactions reflected in. Means how do you get the market risk? Reflected in banking book, trading book, banking book and trading book. Banking book, trading book and off-balance sheet exposures. So market risk arises because of what? Banking book, trading book, banking and trading, C. D is banking, trading and off-balance sheet. Let me see. What do you answer? Let's see. I know maximum of you will answer, one answer I know, which you will answer. Let me see. Are you answering the same? What do you think? Generally, we have a habit of whenever we see that all the comprehensive answers are there, means all are included in some option. We try to answer that only. So here if you see D, banking book, trading book and off-balance sheet exposures, many of you will tend to answer that. Banking book, trading book and off-balance sheet because it includes everything. Jo chahiye wo le lo. You take anything, I'll give you everything. Okay? So this, many of you will answer this, but this is wrong. This is not the answer. Banking book, trading book and off-balance sheet. That is not the answer. Why? Because see this. Market risk means what? Unknown. The fear of unknown or the risk due to unknown. Okay? In banking book, whichever bond you purchase, you keep it till the lifetime of that bond. Till the maturity. So, the question of selling doesn't arise. Here, market risk arises whenever you are selling something. Whenever you have to sell something. If you don't have to sell something, then no question of market risk. Means it's that example. See here, I'll give you a simple example. I am having two flats. One in which I am living. I am living in one flat. Okay? And second flat is the investment. I've just made one investment. And I am holding that flat. Okay? Investment. Now you tell me the price of both the flats increases. Let's say I had purchased both of them for, let's say, 50 lakhs. Okay? At that time I had purchased 50 lakhs each. Okay? Now the flat in which I am living has gone to, let's say, 1 CR. 1 CR. And the flat which I have made for investment purpose, let's say it's gone for 80 lakhs. Or you can call it anything, any number you can give. I am just giving you a sample number. I can give you this 180 lakhs. Chalo, 180 lakhs. So now you tell me, will I sell this flat? The flat in which I am living, will I sell it? Do you think I will sell this flat? Because wherever I am living, okay, I won't sell this flat because my family is there, my all relations are there over there, right? So this is known as banking book, which you are not going to sell. Banking. And this flat which you have purchased for trading, means buying, selling, profits. This is called as the trading book. Okay. So this is a trading book. Got it? So this is the meaning of banking and trading book. So that's why kindly understand, banking book is of no use for market risk. Even off balance sheet exposure, this is also of no use to you. Okay. Off balance sheet exposure is of no use to you in market risk. Because off balance sheet exposure means what? Contingent liabilities. The liabilities which are coming up in future. So the liabilities which are coming up in future, it means what? Bank guarantee, LC or any availization. Where I have given my commitment. एक बार commitment कर दिया तो मैं खुद की भी नहीं सुनता. That logic. Commitment. Okay. So this is nothing to do with trading, this market risk, because I know what the risk is coming up. This is of the unknown. Trading book is of the unknown. So answer is this, trading book. Kindly note, market risk arises on account of transactions reflected in trading book. Okay. Dash is the risk that the value of your investment will fall due to the market risk factors, which include equity risk, risk of stock market prices or volatility changing, interest rate risks, risk of interest rate fluctuations, currency risk, risk of currency fluctuations, and commodity risk of fluctuations in commodity prices. So which is this risk which is all inclusive? It includes everything. Everything is included. Market, this equity risk, stock market is included. Interest rate risk means repo is included over here. Repo, this. Then next one is what? Currency. Dollar is included over here. Then commodity means oil is included over here. So everything is included. Which is that risk which includes everything? Is it market, inflationary, reinvestment, or forex, foreign exchange? Simple one, isn't it? It is obviously market risk, isn't it? Because market risk is all inclusive. These all are inflationary risk, reinvestment risk, foreign exchange risk. These are the parts. Okay, foreign exchange risk is a part of market risk. Inflation risk is a part of market risk. Reinvestment risk is different. You can call it a part of market risk. What is reinvestment risk? Reinvestment risk means when let's say I am having a FD right now at 10% for 2 years. So reinvestment risk means, will I be able to invest in the similar FD after 2 years at the same rate? If not, and if the next rate of FD will be lesser, let's say 7%, then 3% is my loss. That is my reinvestment risk. Okay? Inflationary means inflation will eat up your income available. Kindly note, inflation, what is the meaning of inflation? It eats up your income available. Whatever you earn, and if the inflation increases, then your income is of no use. That much amount your income decreases, isn't it? Clear? So the answer is market risk. Internationally, a committee approach to risk management is being adopted. Which committee deals with different types of market risks? Who deals with market risk? Different types. ALM, so we call it ALCO, we call it over here. Credit policy, liquidity policy, and credit liability management committee. Think. Various types of market risks. Here, there are 3 committees, kindly note. One is CRMC, ORMC, and ALCO. I had taken this earlier. Follow my yesterday's risk topic, risks in banking business. This already I have taken it. CRMC, ORMC, and ALCO. Okay, let me summarize it a bit. Okay, summary only. CRMC, ORMC, and ALCO. Okay, these are the 3 risks. Okay. These are the 3 risks. Okay. So these 3 risks, CRMC covers credit. credit. ORMC covers ops and ALCO covers ALM, this one. It covers a market risk. Actually, you can call it MRMC also, Market Risk Management Committee, but it's called as ALCO. Common name is given throughout the world, ALCO, so ALCO. Asset Liability Management Committee. Okay. So, ALM, Asset Liability Management Committee will handle the market risk. Always remember, ALCO committee's means goal is always two-sided. One, it has to look at short term also, and it has to look at long term also. It's like the bicycle. Whenever you ride a bicycle, you have to pedal also, so that you have to do the pedal so that you keep running, and you have to keep the direct handle also straight. Both the things have to be done simultaneously. Same logic is with ALM. ALM has to look at short term also short, and it has to look at long term also long. Okay? Both the things it has to look at, short term and long term. Got it? Credit policy means committee. Now see this. Credit policy committee can be called as CRMC also. Depending on bank to bank it changes, name changes. Here I can call it any name. Logic is what is the function it is doing, what is the role it is doing. So CRMC can be called as Credit Policy Committee. Also it can be called as this Liquidity Policy Committee. There is nothing called as like this. Means in the risk management framework, there is nothing called as Liquidity Policy Committee or Credit Liability Management Committee. There is nothing like this. Some bank is putting some name and forming a committee. It can be a separate individual bank level. Okay, that is there. But credit risk level or credit management level or risk management level, universally, there is nothing called as these two committees. Okay, CRMC, ORMC, ALCO, and at the top level there is RMCB, Risk Management Committee to Board. Okay. The market risk arises on account of transactions reflected in, already we have covered this. Yeah, now the numerical, I told you, we will be covering this numerical. Read this numerical, everyone. Go through this numerical. XYZ has a risk-weighted asset. If the credit and operations risk are 5,000 crores, market risk is 2,000 crores. Paid up capital is rupees 100 crores. Free reserves are 200 crores. PNCP, perpetual non-cumulative preference shares, are rupees 300 crores. Provisions for contingencies is rupees 100 crores. Revaluation reserves are at 200 crores. Subordinate debts are at 100 crores. Calculate the total capital of XYZ Limited. You have to calculate the total capital only now. Total capital, okay? So how? Here, one important point which you have to notice in this, let me see if I am having the slide, separate slide. No. Okay, important point which you have to notice over here. Let me bring in one open slide. Okay. Give me just 1 minute. Yeah, now it's free. So, look at this now. You have to calculate the total capital. Capital is required. Capital is required. How to get the total capital now? Capital is very simple. See here, what is given? Risk-weighted assets, if the credit and operations risk is 5,000 crores, market risk is 2,000 crores. Then what next? Paid up capital is given as 100 CR. Free reserves are given as 200 CR. So what do you do? See this. Firstly, for capital, you have two types of capitals, T1 and T2, Tier 1 and Tier 2. In Tier 1 capital, what do you have? In Tier 1 capital, you have free, means shares, net profit, revaluation reserves, PNCP and IPDI. These are the elements which you have in Tier 1 capital. In Tier 2 capital, that is known as paid gone capital or paid capital. Here, all the other remaining parts are there in Tier 2 capital. So try solving this first. Let me see. First you try solving this. Let's start. Here, what we have to do is, we have to look at T1 and T2 capital first. Okay, Tier 1 and Tier 2. What do we include in Tier 1 and Tier 2? Kindly note, in Tier 1 capital you include this reserves. This one will be included in Tier 1. This one will be included in Tier 1 reserves. Reserves will be included. Then paid up capital will be included. Then PNCP will be included. Perpetual non-cumulative preference shares. These are the part of Tier 1. Then what will be included? Preference shares, no. Preference shares, provisions for contingencies, no. Revaluation reserves, yes. This will be included. Because this has become a part of Tier 1 now. Kindly note, some books give this into T2, but it's not T2 now. It's a part of Tier 1. 45% we have to take it. Means we have to take it 55% discount. So 55% discount means out of 100, I have to consider only 45 rupees. So out of 200, it will be 90 rupees, right? 900. Subordinate debts, T2. So let's solve this. Okay, so let's solve this. What? First consider this T1. Okay. Yeah. First consider the Tier 1. In Tier 1, what do we do? Let's calculate Tier 1 first. In Tier 1, you have first 100 CR. What is 100 CR? This paid up capital. Then free reserves, 200 CR. So 100 plus 200. So let's calculate it over here. 100 CR, T1 will calculate it first. What is that? First one was what? 100 crores was free reserves. Yeah, what was it? Free reserves. Yeah, paid up capital. Paid up will be there. Paid up. Paid up will be there. Then reserves will be there. Reserves. Reserves will be there. Then next what will be there? After reserves. Then you have, what was the next one? PNCP was there? Yeah, PNCP. 300 crores, no? PNCP 300. PNCP. Then what do you have next? You have, I think, the revaluation reserve was there. Reval. So reval reserves. Okay. What is the amount of paid up given? Check this. Paid up. Paid up is given as 100. Free reserves is given as 200. PNCP is given as 300. Revaluation is given as 200. So this 45% you have to take. Write the figures. Just write the figures. 100. 200. Then PNCP was that. PNCP. It is the PNCP. PNCP was what? 300. 300. And this is what? 45% of 200. 45% of 200. Right? So now do the total. The total of this is what? Do the total of all. 3 plus 3 is 6. 6 plus 2. No, 6 plus 90. 690. Isn't it? So this will be 690. Okay? 690. This will be 690, right? So T1 becomes 690 CR. CR. Now next T2, Tier 2 capital. Tier 2 is what? What is given in Tier 2? I think so. There are two figures given. Let me see. What were the two figures over here? Preference provisions. Provisions for contingencies. This is one. Okay. Shall I mark this blue? Hold on. Yeah. Let's mark this blue. This one. Contingency is 1. Then second one is what? Subordinate debt. 100 crores. This one. Then what? Anything else? Anything else given? No. Okay. This much only. So what is it? See here, the figure is 1.25% of the RWA or given figure for this subordinate debt, this contingencies. Okay, this figure is always 1.25% of the RWA or given figure, whichever is higher. So now RWA, you have to find out RWA. Now what is risk weighted asset? Now find out RWA. Risk weighted asset is given as what? Total, look at this risk. What is this? Credit and operations risk is 5,000 crores. Risk weighted asset. Okay. Market risk is 2,000 crores. So add these two. 5,000. See, total risk is what? Total risk weighted asset is, I'll write it over here. Total RWA is RWA equals to credit plus market plus ops. All the three. So two have been combined already. It's given. What credit and ops is given as 5,000. So these two are given as 5,000. So it is 5,000 plus what is market given? I think so it is 2,000. So it is 7,000. So what do I want? 1.25% of 7,000. So this into 1.25%. So what is the answer for this? 1.25% of 7,000 or this figure. So what will be the answer over here? 7,000 into 1.25. Do it everyone. What is the answer? Let me try it on the calc. Even I don't remember the figures there. Isn't it? We should always try to do it on using the calc. We are so much used to machines now. Right? 1.25 upon 100 into 7,000. So it is 87.5. What are you getting it over here? Whichever is higher. Okay. So 87.5 you are getting. So this is 87.5 or given figure. What is given? Given is I think so 100. So 100. Whichever is higher. So we'll take this 100. Whichever is higher. So we'll take this 100. Okay. So 100 I have taken. So what is my T2 now? My T2 equals to this, what was that? Provision for contingencies. Yeah, contingencies was 100 CR. So this is brought at 1,100 CR contingencies. Plus, what is the second one? Subordinate debt. Subordinate. So that is 100. What is the figure? 100 plus 100. So that's equal to 200 CR. So at T2 becomes what? 200 CR. Okay, tier 2 is 200. So what is the total capital then? What is the question asked? Total capital of XYZ. So total becomes 200 plus 690. So 890. So total capital becomes 890 CR. This is your answer. 890 CR. Okay. So kindly understand, whenever you have to calculate the T1 and T2 capitals, you have to see to it that revaluation reserves are to be taken in T1 part and contingencies are to be taken at 1.25% or given figure, whichever is higher. So this is what you have to take. That was it about this numerical. Now before going, let me show you the batches, the new batches. Okay, the new batches over here. Look at this. Go through the new batches. See this. Go to ATAT 24/7. Always go through the app only, because in the app you will be getting 1% extra. Download it. It's available on all this Play Store also and this iPhone also. Okay. So go through it. Go to Adda 24/7, click on JIB and CIB, look at this. Click on JIB and CIB. Click on CAIIB June 25. Latest batch we just started. Click on this. Bonus batch. Join this batch ASAP as early as possible. Just now it is started. All the numericals, objective questions, case studies, everything is covered. Click on this. See this. Ebooks, mock test. These ebooks are to the level of chapter wise. Mock tests are to the level of chapter wise, per chapter. You are having it. So, this is what you are getting. Plus, if you look at the discount part, what is the discount part? Click on buy now. Put the code Y432. Look at this. Y432. Click on apply. Apply. Look at this. The discount part, what are you getting? 80% you are getting. 80. Plus 1% extra if you purchase through the app. So 80% plus 1%, 81. So never forget the code Y432. And never forget to download the app first and purchase through the app. Also, you can join the Mahapack. In Mahapack, once you join the Mahapack, here you get 15 plus batches per subject. Okay? 15 plus batches per subject you are getting. So the JIB and CIB. JIB, CIB, Mahapack. Okay? Now double validity offer is going on right now for all the Mahapacks. You can join the CIB Mahapack separately. The JIB Mahapack, JIB, CIB Mahapack, you can join, view all, and you'll see these Mahapacks, other ones also. CIB Mahapack 2.2. Join the CIB Mahapack. Right now, double validity offer is going on. If you buy for 6 months, you get it for 12 months. So join this immediately. Okay? In fees of 6 months, you are getting 12 months. Again, ebooks and everything you are getting, ebooks test, but obvious. But never forget a code for this. The code is, see this. Again, I'll tell you, because we are bankers, we have a habit of forgetting the things, right? So Y432. Okay? Got it? Y432, 80% discount plus double validity. So don't miss it. Okay? Bye from